Very good evening, everyone. It's been another difficult day across European equity markets. Just check out some of these prices. London closing on the very low of the day, off by some 4%. It's not many times over, well, a particularly long time period, maybe even a decade, where you can say that the FTSE 100 has closed either up or down on any one day with a 4% handle. The Dutch stock market closing off by 3.8%. Losses not as severe in France and particularly Germany. With investors taking flight from risk around the globe, carry trades are unwinding, causing the yen to soar. The dollar has traded down as much as 4 cents versus the Japanese currency, breaching the psychologically important 115 level by a long way for the first time in a year. High yielders have experienced an equally sharp decrease against the yen, nearing the steepest decline in 20 years, as deleveraging and moves into defensive positions dominates trading. Boris Schlossberg is senior currency strategist, dailyfx.com. This is pretty spectacular, Boris. 4 big figures on the yen? Yes. What's your view? What's your take on what's happening?
Well, you know, it was just a sheer pandemonium all the way throughout the night last night. Basically, what we've been having all day long is just a cascade of stop running. We broke the 116 handle, then we broke the 115. That triggered lots of stops. It went all the way down to 1350, had a small bounce, and then broke the 13 handle and went all the way down to the 12 handle. Now we seem to have bounced back, found a little bit of stabilization. A lot will depend on how the Dow Jones ends up the day. If we can stabilize and perhaps rally into the close, that should stabilize the dollar-yen pair. If we end on the lows like the FTSE, perhaps more selling into the Tokyo session.
You know, Boris, I suspect that there's some ladies and gentlemen around tonight, the ones that have real seasoned market participants who have been around for a very long while, that would probably be chuckling to themselves to some extent because the market needed a clear out. And my goodness me, it's certainly got one now wherever you look.
Well, you know, it sure did. You know, when you saw stories of Mrs. Watanabe beating traders from Deutsche Bank and UBS, like we did last month when everybody was long carry and the professionals were getting killed, but the retail traders were making a lot of money, you knew that the end was going to be near, because it's just when there's a one-way trade, it almost never ends nicely. It ends very much in tears, like this one is doing right now.
Do you see long-term repercussions of this level of volatility? Does it scare investors away for a while?
Yes, it does. I mean, this is, you know, the first cut is the deepest, and this one is going to, I think, last. We probably will have a bounce, but very likely have a retest of the lows and, you know, settle down. This is not a situation where we're going to go right back into the carry and risk appetite is going to return tomorrow. I think we've done very serious both technical and fundamental damage here. The background looks like global economy is suddenly slowing, much more substantially than the market initially thought. We're now talking about rate cuts from the Fed and perhaps even a halt from the ECB. So the whole background, and we've had also disappointing GDP numbers out of Europe this week, basically suggesting that all of this growth scenario that the currency markets have been pricing in may have been too optimistic. So sentiment has certainly changed, and it's going to take a long time to get it back in the right direction.
Boris, you don't think the Fed is going to cut, do you, within the next week or two?
It may be a situation where they have no choice. You know, it's one of those kind of things where people talk about the fact that monetary officials have a decision in their policy-making apparatus. In fact, markets force monetary officials very frequently to make decisions. They become reactive because markets will take things to the extreme, especially speculative markets. They never play nice. They will push things all the way down, and they could push dollar yen to 110. They could push rates on the 10-year all the way below, 4.5 level, and that will just force the Fed to begin easing rates because there'll be such sheer talk of recession, in the markets and such fear and panic that they may have to act reactively.
Is the bottom line lesson here? Sure, have your quantitative trading models, your black box computers, whatever you want, but have human beings running alongside them that they can keep their eye on what's going on and be able to jump in when the computers clearly are not right.
No doubt. The biggest fallacy in the world. We are huge adversaries of quantitative trading. I mean, quantitative trading is simply applying statistical models on something that cannot be modeled, which is human behavior, which is going to be different every single time. It's applying the concepts of physics to the concepts of psychology. And markets are not logical, they're psychological in nature, and therefore quantitative models always will fail in the end. And that's why they're going to be very difficult to control.
All the best to you, sir. Thank you very much indeed. Boris Schlossberg, Senior Currency Strategist, DailyFX.com.